Joe, thanks for joining me on the podcast.
Thanks for having me. Excited to be here.
I've got to say that you, more than any other investor in Australia, are probably the one that I've learnt the most from. So the fact that you have decided to join me is just awesome.
Well, that's very kind of you. I appreciate that. But yeah, it's great to be here.
Great. We're going to get stuck into lots of investing talk, but one of the things that I'm also going to pick your brain for is coffee spots in and around Sydney or Melbourne.
That is a core competency.
Yes. And it's something people probably don't know about you, actually, your love of coffee. And you even show me places in Melbourne, my own city, that I don't know about. So that's great. I'm sure that the audience will love that. Before we get to that, there's two things I'd like to say. Firstly, this conversation is going to be recorded for Facebook and YouTube. If anyone wants to watch it on those portals, go right ahead. You can also probably get it on your TV. Secondly, I want to say thanks to you, but also thanks to the Motley Fool. That's how we know each other. That's how our paths crossed. And I think it's testament to them and the principals and the team there that I'm able to talk to you on air like this.
Yeah, cool.
Yeah. So, Joe, let's go back to the beginning where your passion for finance started. People could probably tell from your accent that you're maybe Midwest Australian, grew up.
Oh, yeah, mate. Yeah.
Yeah. Okay. So take us back to where it all began for you, mate.
Sure. So I got to start pretty early in investing. I've always just been commercially curious. Mm-hmm. And my granddad, who was an entrepreneur, retired in his late 30s, very hands-on guy, really nurtured and fostered that. So he built a lake house in his free time with his bare hands with a buddy up on Lake Burton in northeast Georgia. And I would spend my summers up there along with my cousins. It was an amazing experience, but while most of the other kids would be out playing in the water and doing woodsy things, I'd be hanging out with my granddad, who at that point mostly spent his time building things with his hands and managing his own money. So he was super passionate about investing and markets, and I would sit around with him and he'd talk about the businesses he owned and why. And we'd watch CNBC and he'd talk about what mattered and what didn't. And I was just totally taken by it. And there was this tradition where he felt like 13th birthday was a really big deal. And so he would give each one of the kids in the family like a really special gift when they turned 13. Mm-hmm. So my older cousin, he got a hunting rifle. Another cousin got a piano. And I got 10 shares in Shaw Industries, which was then the world's biggest carpet manufacturer. And I was thrilled. I was like, oh, this is so cool. Like I have a stock certificate and I got quarterly dividend checks in the mail. They were like, $1.50 or something like that. No, it was awesome. I loved it. And that just really planted a seed for me. Mm-hmm. And that just kept rolling forward.
When you said he was an entrepreneur, what did he do?
He and his brother started a business called Georgia Sprinkler. And so when the government rolled out mandatory sprinkler systems in large-scale commercial buildings, they just seized the day and won a ton of business. And
you didn't get a rifle, but you got share certificates? I mean, that's pretty
I did. Cool. A quick funny story about where those landed. Two funny stories. One is that it kind of led to my intro to the Motley Fool, which was my grandmother at the time. She was always my grandmother, but she found an article in the paper back when, people read newspapers. Mm-hmm. And one day she's like, Joe, I heard that Shaw is splitting their stock and, Pop was having trouble explaining that to you. I just read this article from these guys called The Motley Fool, and it seems like they do a good job explaining it. So I just read it and I was like, God, this is so clear. Like they just made this really complex thing really simple. And I'm just, a teenage kid and I can understand this very plainly. And that just, started reading the column and later the website. And
do you remember who wrote that first article?
I would guess that was Selena, but back then it was so long ago, it's possible it could have actually been Tom or David, but would have been a long time ago.
That's cool. It's a great story. And we'll come full circle on that in a moment. So most kids, when they go through school, they think, I don't know what I want to be when I grow up. They go see a career or some sort of counselor that helps them with that type of thing. And they, even if they get a few years into their career, they still don't know what they want to do.
I did not have that problem.
No, it seems like from, 13 years of age, you knew once you got that stock certificate where you were going to be.
Yeah. No, I've always been really passionate about equities. My first job out of undergrad was investment banking, and it was a really good experience. I learned a lot. Learned a lot more about hard work, but it wasn't my passion. I really wanted to work in equities, and particularly I wanted to work at the Fool because I was just really passionate about the Fool's mission and style and long-term investing and business-focused investing. So I was really happy when that came together a couple years after I got out of school and moved on up to Alexandria.
So it was the University of Georgia?
I went to Georgia. Go Dogs. Yes. For undergrad. It was the only school I applied to. I want to go to the business school there. I've also been a lifelong Georgia football fan. And then I went to Georgia State for Master's in Finance, Master's of Science in Finance. I did that while doing investment banking, which is just a brutal couple of years.
What have been?
Well, getting back to like being focused, I would say there's probably a little too much focus back then because in MS in Finance, while you learn a lot doing it, the irony at the time was I was like, well, I don't want to go after an MBA because I'd learned things like management and marketing, and I don't need to know that if I'm an investor. Oh, young Joe. So if I could have wound back the tape a little bit on that, that would have been good. But overall, it was a good experience, and just to work on blocking and tackling skills and invest in that early.
But you got the experience, obviously, in your career, and then you proceeded to do the CFA?
Yep.
So you've definitely got the academic side. Now you're getting the business and investing side, or you already have. So let's talk about from the time that you transitioned away from that investment banking job. Am I right in saying that you went to become a sub-editor at the Motley Fool?
I was a sector editor. So my job was I was the lead editor for energy, materials, manufacturing, telecom. It was more or less all these different sectors and industries that no one else at the Fool wanted to cover. So they gave him the new guy. But as it turned out, that was around, I started in early 2007, and that was a stretch where those industries just went completely gangbusters. And oil was rocketing. Australians probably remember well that was a pretty awesome time for resources. Ironically, the best lesson coming out of that for me was that even though I developed a lot of domain expertise in those spaces, I was like, these are terrible industries. I don't want to invest in these.
I was going to say, they're all industries that you tend to avoid.
Yeah. Well, I got up close and personal with them and basically learned, okay, well, they're really cyclical. Almost all of them are price takers. They're really capital hungry. Reinvestment is really difficult. So even if you have an oil field that turns out to be wildly productive, really low cost, finding another and catching lightning in the bottle a second time is unlikely. Combine that with those businesses tend to be run by zealots. There's a lot to dislike about them, and sometimes those early experiences are really good at just telling you what not to do rather than necessarily what you should be doing.
I think we've all had a few of those experiences, especially earlier on. You must have had a pretty good impression on Tom, David, and the rest of the team at the Fool, because you quickly progressed from being the sector editor to appearing on TV, international visits for companies, that type of thing. How did it take place that you went from there to working on Inside Value?
Getting on TV, I can tell you the hierarchy was: is Tom Gardner available? No. Is Bill Mann available? No. Tim Hansen? No. Tim can't make it. Joe, how are you? I'm good. I'm good, guys. That was kind of how I started doing media. But yeah, I worked my way over to IB. Ironically, I was a charter subscriber to Inside Value many years before. So that's a really windy journey that I ended up running it. It was an awesome experience. I worked with Philip Durrell, who'd been running the service before me, had done an awesome job. He was a great mentor to me. Had a really good team there. Had a lot of fun. But I'd say my spin on value investing was pretty different from a lot of others, and I'd say that hasn't changed. So my first recommendation there was Google, which now people look at Google and they're like, oh, it's an empire of network effects, and even though I think it's still Alphabet is undervalued today, back then, this was 9 years ago. That was a fairly contrarian move, at least among contrarians, to be long something like Google. But it was fun to take it in a different direction, and the results were good.
I'm keen to drill into this, and we'll get to specifics in a moment. But you say take it in a different direction. Where did that come from? When I look at the way you invest now, and I have a lot of respect for the way you go about things, Where do you think, were there some influences in your career early on that shaped you?
Yeah, I mean, a lot of them. I'm a naturally cautious person, which a lot of people don't assume when they look at some of the things we own, but I don't ride bicycles, for example. Those things are dangerous. I don't ski. I don't gamble. Like, all these things, like, no, I don't do that. That's risky. I'm afraid of heights. Like, there's all kinds of stuff that I just don't like. Long, downside. I don't like tail risk. But so that's something that, even though we're growth-focused investors and probably more focused on upside capture than downside, I am still very cognizant of downside capture for those reasons, because that's just who I am personally. Over time, I got a lot more upside-focused from following a lot of great investors. David Gardner would probably be the one who springs to mind the most. I had a discussion with Tom, this would have been, close to a decade ago. And he was like, look, I want you to just take some time and study some of David's biggest winners. Take the top 10 just as a starting point and come back and tell me what you thought the discerning factors among them were, something that's replicable. Fully appreciating that 10 investments is not a robust sample size. But, some of David's wins, I don't think people realize, because David doesn't run funds and he's in newsletters, I think people don't quite appreciate his body of work as much as they should. But a simple example of one of David's wins was he invested in Amazon and has held it since. Cost basis, split adjusted US, a little over $3. And I think we're around 1,600 today.
Yeah, wow.
Not too many people can lay claim to that and to have held it that whole time. And David has, so far as I know, that's far and away his biggest, but he's had some other very large hits. So I have a lot of respect for him. One of the big things I took from David was, one, like, it's fine to focus on, protecting your downside of being cautious, but that doesn't necessarily mean you can't be upside conscious. Well, two, his big wins all had self-reinforcing dynamics to them. And that could be around network effects. It could be around scale. Odds are good that there's an intersection of those things and extreme customer loyalty. And as the business is scaled, the odds of success continue to improve, but also the optionality and the TAM's expanded, total addressable markets expanded as well. And investors are often really slow to appreciate that. And yeah.
And he has and I'll link to this in the show notes, but he has a really clean and concise way or methodology that he uses to think about these opportunities. It's something that I've gravitated to as well over time because it makes sense. Let's circle back to that, your time at Inside Value. I've got a quote here, and for those who don't know, this newsletter, this service that you ran was one of I think it was the best performing over 5 years from a sample of 200 in America or something crazy.
There was a stretch there where it was the best performing over years. It had a good run. We had a good team.
Yeah. One of the quotes that I got from this summary of the Motley Fool at the time, but also Inside Value was, and I'll quote, it said, Inside Value sometimes recommends companies that would otherwise be considered growth stocks. It went on to say a current example is eBay at 26 times, which had a price earnings of 26 times, but also price to book of 3.2. And I'm going to say, is this where you really honed that ability to understand, like you said, increasing addressable markets, optionality, network sizes? Is that where you'd say?
Yeah, I spent a lot of time focusing on those. I'd say, Inside Value was the first time I had a senior role as an investor and someone had given me the car keys. I'd say I was still learning. I'm still learning today, but that was probably earlier on my journey. But yes, there was a lot of evolution there. And if you look back on the eBay thesis, that was really more a PayPal thesis than an eBay thesis. At the time,